When it comes to money, there's one group that's more powerful than every trader on Wall Street. That would be the government's bank, the Federal Reserve.
People listen to the Fed and they respond to what the Fed says about the future.
When you listen to the Fed, you get at least one studied outlook about what the future is going to look like.
The Fed's press conferences, held every 6 weeks or so, tend to cause swings in the stock market.
Over time, central banks have moved from being very secretive about what they're doing to being more transparent about their policy decisions. And part of that transparency is signaling where policy is likely to go in the future.
The Federal Reserve has hiked interest rates 7 times in 2022. That's a relatively rapid pace. This and a historic drawdown in the bank's bond portfolio is weighing on stocks across the board.
But there's a lot of other forces that are affecting the economy.
By the time they usually start trying to slow things down, it's gotten to a pretty bad situation.
So how does the government's bank use words to control stock prices? And how can investors take a soundbite and turn it into profit? Forward guidance refers to public comments made by leaders of the central bank.
Let's talk about forward guidance in 2 different ways. The first way the Fed does forward guidance is actually a very overt way, which is it tells you how they think the economy is going to evolve. The other way the Fed does so is in language, which can be very subtle.
Some economic models say forward guidance is incredibly powerful.
The idea was that by changing people's expectations of the future, you can change their behavior in the present to make the present better.
Here's how it works. A member of the voting committee makes a statement. The statement contains a vague but definitive description about a forthcoming action.
We side by side compare the statements that it release month over month, highlighting the differentiation and like a word. Literally, people in finance get hung up on a word. There is a little bit of tea leaf crystal ball that certainly goes into parsing the Fed words.
Investors cracking the Fed code are listening for key phrases like
softening of labor market conditions,
or
we expect to maintain an accommodative stance of monetary policy until these outcomes, including maximum employment, are achieved.
If you notice what Powell said during the pandemic, we're not even thinking about raising interest rates. That's forward guidance. When the Fed says
we're buying 120 billion in securities per month across the Treasury curve, that's also adding to accommodation.
That's forward guidance. It's a very powerful tool.
Some of the most potent Fed statements are about the future path of short-term interest rates.
The Fed sets the interest rate that it pays on reserves held by banks, sort of the same way your bank sets the rate it pays on deposits.
There's this connection between short-term interest rates that are closely connected to monetary policy and the interest rates on mortgages, auto loans, things like this, that would be more relevant to household decisions.
The Fed sets a target for these interest rates about 8 times a year. Over the past 20 years, the target has stayed low, with extended periods at 0, a historical anomaly. Economists say that taking this interest rate below 0 is a bad idea.
You can't set an interest rate less than 0 because people would just store cash in their mattress instead of investing it with you.
And all this was because they didn't see the ability to add accommodation to the economy.
So instead, the Fed tries to set expectations with their words.
Everybody does their best to set expectations going forward, depending on what this guidance is. And like the 8 words that they change monthly is something like everybody drools over and tries to get their crystal ball and say, oh my God, that's what they're really thinking.
We would think that maybe you could get a couple of percentage points. So effectively having negative 2% interest rates through these alternative tools.
That said, people at the central bank say many outside forces affect prices in markets.
It's not the case that the Fed can perfectly control how investors or markets will respond to its statements.
As you saw in 2022, when expectations were behind the curve and suddenly they had to change policy very quickly and hike very rapidly, the markets did not like that at all and sold off very hard because then there was this disconnect.
Stock market investors haven't always gotten such explicit guidance from central bankers.
As subtle as you think it is now, it was way more subtle way back when. First of all, there was no forward guidance. They never even put out a statement until the early 90s. When you go back to that time period, this is actually overt and hitting you over the head.
You go back to the 70s and the 80s, the Fed didn't talk about its policy publicly very much at all. It would finish a meeting in which it decided to change the stance of interest rates, and it wouldn't tell anyone until 8 weeks later.
Forward guidance became an official policy tool in the 2000s.
I would say that's in part due to Chairman Bernanke's leadership, but also in part due to the exigencies of the situation, of the episode that occurred under his watch.
As an unprecedented housing crash developed into contagion on Wall Street, the Fed took interest rates to zero.
There's this constraint of zero. And so instead of going lower, the FOMC included language in their policy statements that interest rates would remain low for a considerable period.
People generally think that this had a positive effect on our economy during those tough years. And when you're sitting there at the zero lower bound without an ability to lower interest rates any further, any port in a storm, if this has some theoretical possibility of working, great.
In addition to forward guidance, the Fed tried another new technique.
Large-scale asset purchases, or LSAPs, LSAPs.
The asset purchases swelled in Ben Bernanke's time and nearly reached $9 trillion in the pandemic. Now, the bank is letting some of those bonds mature.
What they're doing with their balance sheet really matters. And I don't think they're ever going to get their balance sheet back to where it was pre-2020.
Central bankers know this technique could have drawbacks,
including the risk of impairing the functioning of securities markets and the extra complexities for the Fed of operating with a much larger balance sheet, though I see both of these issues as manageable.
Probably the balance sheet has more of an impact on stocks than even interest rates, in that the balance sheet purchases or quantitative easing provides liquidity to markets that finds its way into stocks and ends up increasing values. And so reducing that balance sheet quantitative tightening probably has a bigger impact on the stock market as changing interest rates.
Much of the modern economy depends on the Fed's ability to control narratives.
Well, central bankers, they want to have credibility. They want to be believed. One way to do that is to say what you're going to do and then do it. Some central bank policymakers, though, worry that doing that will tie their hands too much. They'd like to have the flexibility to respond to unforeseen circumstances.
The bank did use this technique before the Great Recession, however. For example, the Fed provided forward guidance as stagflation took hold in the 1970s and early 80s.
The Fed did learn lessons from the 70s not to ignore inflation until it becomes too big of a deal.
But a failure to restore price stability would mean far greater pain.
Powell has been indicating more recently, hey, trying to wake the market up and say, hey, this is not something we want to reverse on, which was a mistake in the 70s and 80s, and he has referenced that multiple times.
Wall Street's current down cycle kicked off with a rare admission at the Fed. It waited too long to act on inflation.
I fear that they took a gamble, that inflation wasn't too real at the beginning of 2021. I think they know they gambled and lost, and that they have to do something serious in order to get inflation back under control.
Even when the Fed pivoted rhetorically, as in the language we were talking about when it comes to forward guidance, which Powell did, I believe, on November 29th or 30th of last year, it didn't really pivot very quickly in policy. Rates went up on talk, and that is the power of forward guidance. So the Fed played a bunch of catch-up, and what it did was it raised rates as aggressively as we've seen since the 1980s.
As a result, the market has trended downward for months.
To put it simply, the higher interest rates, the lower relative value stock prices have.
These companies that year over year were producing 20% returns that people felt so comfortable with, and then suddenly the giants of the investment industry started to fall. You had Apple and Amazon, stalwarts, making tons of money for decades, suddenly down 40-50% on the year. Tesla's down 50%. You had some a little bit, Microsoft's held up a little bit better. When rates are going up, we're going to see some harder times, which then means maybe stocks that aren't going to make as much money.
Some speculators in the stock market hope that the bank will pivot from that plan.
We do think the Fed is going to pivot harder than they're saying right now.
The pivot has been redefined 3 times. First, the pivot was when would the Fed pivot to cutting rates. Then this pivot was defined as when would the Fed pivot to pausing its rate hikes. Now we have another definition of pivot out there, which is when will the Fed pivot to reducing its rate hikes.
Chair Powell has talked about getting rates higher and keeping them there longer, and yet the market still seems to be holding out hope for a pivot. And so I think there is a disconnect that's been going on for some time.
Many Wall Street advisors have a suggestion: don't fight the Fed.
Fed has the thumb on the scale. So if you have somebody that has a thumb on the scale or has a decided advantage about what's going to happen, whether we think good things or bad things are going to happen, it's best not to fight that policy. So when the Fed is evening or the Fed is holding rates at zero, don't fight it. Run. Take all the risk you can. It's great. Now, when the Fed is hiking and slowing things down, again, the reverse is don't fight them. Things are going to get bad.
The challenge is interpreting what the Fed's messages actually mean.
There are multiple possible interpretations of the Fed's statement that it's going to keep interest rates low for a long time. And in some cases, people may also have uncertainty about what the Fed's ultimate goals are. That uncertainty came back a little bit in the pandemic.
The change in market sentiment far outpaces the change in the rhetoric that actually comes from the Fed. The big risk is one where market sentiment decides that they've heard something different from the chair or from the FOMC as a whole.
Economists now debate the effects of the forward guidance technique.
The limits of forward guidance refers to what we can and cannot accomplish by talking about the future. Figuring out exactly what the Fed's viewpoint is not always easy. To figure out what the Fed is thinking about the economy, you've got to sort of read the tea leaves. That's the dot plot.
Imagine you got up every morning and you could predict how your day was going to go. Well, because the Fed controls monetary policy, it pretty much can predict outcomes, or at least it feels it has the ability to do so.
At the Federal Open Market Committee meetings in Washington, D.C., central bankers come together to set interest rates and construct data sets like this. This chart is called the dot plot. It's published quarterly in the Fed Summary of Economic Projections.
The dot plot is this really arcane way of looking at Fed funds. Literally every person on their board, goes and picks their dots.
The dot plot shows where each Open Market Committee member thinks interest rates will be in the future. In September of 2022, most committee members saw interest rates rising in the coming year. By December, most of the committee saw rates staying higher for longer.
History cautions strongly against prematurely loosening policy.
Now, right now, they're tightening. So again, that's why we're not taking a lot of risks. Again, don't fight them if they're trying to make things harder in the world. That's not good for profits.
Following the Fed's guidance, Americans might prepare to pay more for loans in the short term, while their assets stay priced relatively flat.
But ultimately, longer-term interest rates are going to do what they do based on the beliefs of every participant in the market and how they interact in a market setting. I can look at what the Fed says, and that might affect my personal beliefs. Ultimately, I have to take the rates that the market gives me. So sure, don't fight the Fed, but don't believe too much that the Fed is all powerful.
I don't think folks at home should be trading on the Fed. I think they should be trading for the long term, and the long term is that the economy grows and stocks go up, and that's the way to invest. But if you are going to put that into your suite of information, there's a lot of information there about where the Fed thinks the economy is going to go, and what the Fed is going to do with interest rates.
If they took away forward guidance, your interest rate announcements or policy decision announcement would cause mayhem, especially if it's very unexpected or there was a policy change. So I think it's important because they're looking for stability.